With the exception of Dow Jones, S&P and Nasdaq are sitting close to all-time highs. Indeed, Nasdaq have been making new highs for a while now. The question is, what next, and can the rally continue? What's happening, everyone? Welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, money management tips, and everything that impacts our money. So, feels like we have come a long way since the March lows. In this video, let's investigate a bit and understand how we got here, where I believe we can potentially go next, and what moves I'm making in my long-term portfolio. Earlier this week, the S&P 500 closed at a record. Last time it did that was on February 19th, 2020. Since then, we hit a bear market. Markets eventually bottomed on March 23rd, 2020, plummeting 34%. Fast forward today, S&P 500 is up 50% since the March lows. Some argue we are in the middle of the new bull market, which started on March 23rd, meaning we are almost 5 months into this new bull market. Is this really a new bull market or euphoria? Let's dive a bit deeper and investigate how we got here. Big tech stocks like Amazon, Netflix, and other FAANG names, including Apple, Microsoft, and Nvidia, outperformed the broader market. Remember, big tech makes 26% of the S&P. Demand for toilet papers, sanitizers, and home essentials led to a rise in consumer discretionary names like Clorox and Costco. Stay-at-home stocks made big moves. Companies offering ability to work from home are seeing their businesses explode. Cloud and cybersecurity names like Zoom Video, DocuSign, CrowdStrike, and others are experiencing crazy stock appreciation. And continuing on the theme of stay-at-home, companies like Home Depot and Lowe's saw an uptick in sales since consumers started investing in home improvement projects. Finally, healthcare names like Moderna, Regeneron, and others got investors' attention with hopes to release the vaccine. Net-net, tech led the rally with strong support from consumer discretionary names and healthcare. And let's not forget, the Fed has pumped insane amount of liquidity in the market. A 51% rally from the lows sounds like a strong recovery, but here is the problem. This is not a broad rally. Industrials, banks, energy, leisure and entertainment, restaurants, airlines, and retail have not been a part of this record rally and have remained laggards. So where do we go from here? It's not much about good versus bad news, but more about are things getting better or worse. There are reasons to stay bullish. Improved consumer spending, a rebound in housing market, better than expected corporate earnings, hopes for a vaccine and further stimulus have added to investor optimism. Also, investors view the markets as forward-looking, anticipating how the US economy and corporate earnings will perform in the next 6 to 12 months. I do believe we will be in a much better shape 6 months from now. Having said that, here are some reasons to get worried. Any setback in the timeline for developing a vaccine could change the tone in the market. Stimulus has played a big role in keeping the economy going. Markets are expecting more stimulus in the short term. Any indication of no more stimulus will be a problem. Renewed tensions between US and China can fuel volatility. Economy is shaky with record low GDP and disappointing unemployment data. And then just yesterday, Fed cut their economic outlook for 2020. Here is my take on this. And of course, I wish I had a crystal ball so I would be right all the time. I think we are in a new bull market. But I'm worried that the rally is not broad. Like every bull market, there will be corrections on the way. With a 50% gain in S&P 500 and 65% for Nasdaq since March 23rd, we have come a long way. I believe we are ripe for some volatility and maybe a correction. Also, seasonally, August and September have not been the best months in terms of return. It's time to be a bit cautious, but still stay invested. Again, you gotta believe that we are in a new bull market, and eventually the rally will broaden into other beaten down sectors. The pandemic will soon be behind us, and it will be business as usual. Of course, not at pre-pandemic levels. That's gonna take years. Here's my 2 cents. If you've been on the sideline all this while and just watching this rally, now is not a good time to come in with huge amount of cash. On the other hand, if you're invested and enjoyed the rally, I don't think you need to sell and go cash. Now, some of you know I have my long-term portfolio in M1 Finance. Here are the moves I'm making. Number 1, rebalancing my portfolio. I'm heavily invested in leverage ETFs. My target allocation for leverage ETFs is 35%. In March, these ETFs got hit the hardest, and I've been adding new money to dollar cost average it out. And the strategy has paid off big. Last week, these were at 52% of my portfolio. Earlier this week, I sold some leverage ETFs and rebalanced it into actual stock names. I mostly sold tech-heavy ETFs like TQQQ and TECL. I'm still invested and mildly overweight. I will rebalance a bit more in next few days. I think it makes sense to lock some profits on these leverage ETFs and rebalance into safer bets. Number 2, continue investing. I automate my investing, and so should you. Every month I put in new money into my portfolio. We'll continue doing so as planned, but will not double down like I did in March, April, and May, when I literally put in 5 to 6 times more to take advantage of the dip. Number 3, accumulating the laggards. Continue to pour money in laggards. UDOV, for example, an ETF that focuses on Dow Jones, has been a laggard, but I think this will catch up as the rally broadens. That is my plan. What are you guys doing? Drop me a comment. Would love to hear some opinions. That's all I have, guys. Thanks for tuning in. If this was helpful, hit that like button, and if money gets you going, consider subscribing. Until next time, peace.